Hello there. This is video number 1 of a series of videos that I'm going to be making to accompany my payroll accounting class offered at Fresno City College. I'm making these videos just as a resource for students to perhaps watch and may be especially valuable for those students taking this class online, where there won't be an opportunity to listen to lectures in the classroom. So I wanted to provide information explain some of the concepts in the text in a way that students can perhaps understand it a little bit better. I'm not going to be holding students responsible for anything other than what is in the text, so there isn't any information on these videos that are going to be that's not included in the text that will be on exams, but hopefully that students will find some value in this. They are certainly not required to be watched, and if they're helpful, great, and if they're not helpful, well then no harm done. So we are going to be using the payroll accounting text, the 2022 edition, which you will be purchasing online and will be part of your Cengage account, which is where we'll be taking all of our exams and you'll be doing your homework. And so I'm just going to be reviewing the chapters in a series of videos here. You can see that in the table of contents that the textbook is actually made up of 7 chapters. We're going to be covering the first 6. Notice the 7th chapter is a payroll project. It's a pretty massive project, and we will not be doing that. I'm not going to assign that as an assignment. But the first 6 are actually the informative chapters. The first one is somewhat of a summary chapter, highlighting what's going to be presented in the remaining 5. But we are going to go over these chapters in order, in the order that the authors have presented them here in the text. Starting with Chapter 1, I foresee Chapter 1 having about 2 videos. It goes pretty quickly as far as there's no computations or anything like that. It's just an overview of what the payroll function is and what things that we're going to be looking at. So I'm going to open it up. I have already highlighted some areas that I think are important. However, your textbook and your homework management system won't have highlights, but you're certainly welcome to highlight them. So, this first chapter, the need for payroll and for the records, is broken down into a series of different areas. And we're going to go through them, and I'm going to start with the very first area, the chapter introduction. It starts off, I noticed that the authors made the comment that it's not easy being an employer, and I think that by the time we finish this course, we're going to find that that is true, that being an employer carries with it a lot of responsibilities, and it's rather difficult to be an employer. So I have had students start this class because they are going to hire employees, and they wanted to know, just how to take care of the payroll function. And my advice to them is to get a payroll service to start with until they complete this course, because there are many legal do's and don'ts that we're going to be covering throughout the course. Entire careers have been made just as a dedication to the payroll function. There are many aspects to it. We are not going to cover the entire human resource function in a business, but we are going to talk about most of the more common payroll requirements. And I think that we're going to see that they are a bit more complex than we thought they were. We are going to be looking at this function from the employer's point of view, not the employee's point of view. But as an employee, it's good to know what's going on behind the scenes. So I think we've all probably received a paycheck or seen a paycheck, and we know that there are certain things that are taken out of it. Perhaps we don't know exactly why that is, why things are being withheld. But that's what we're going to cover in this class, is why the employer has to withhold certain things from employees' paychecks and the other things that they have to pay in addition to that. No matter what size the company, if the company has employees, whether they have 1 or 10,000 employees, they all have to be paid. And that task can be difficult if someone doesn't know what they're doing. Employees, employers, and government agencies monitor the work performed by payroll professions. I believe this statement is absolutely true. The payroll accounting system is the only operation in a business that's almost completely governed by law and regulations. There's not much wiggle room in payroll. Pretty much every single issue has been addressed. It has been decided how certain issues should be handled, and anyone working in the payroll function needs to know what those rules are, and they are being watched. Employees watch employers. We have to file reports with the government, and governments are the government agencies, the Department of Labor, the Internal Revenue Service, all monitoring the function of every business to make sure that they're doing what they're supposed to do. Not knowing what to do, you're going to make mistakes, and that's what we want to try to avoid, because those mistakes can be costly. The fines involved in the payroll function are usually higher than the fines involved in the income tax function, because as an employer we have a fiduciary responsibility to our employees, and not fulfilling those responsibilities comes with a pretty heavy burden, penalty. Both monetary and there could be criminal penalties as well. So we want to make sure we know what they are, and that's what we're going to examine in this course. Is what are some of the things that we need to be familiar with? Okay, the payroll profession, of course, involves paying employees, and generally the lower level where people start in the payroll profession in a business is probably as an entry-level payroll clerk, where they're actually gathering the time and maintaining the employees' records as to rates of pay, that type of thing, just to make sure that employees get paid what they're supposed to get paid. Job responsibilities include, I'll let you read those, but they have to do with making sure that we maintain all of the information about the employees, as well as the laws in effect, to make sure that the employees are paid properly, the withholdings from wages are computed properly and remitted properly to where we need to remit them to, which we'll talk about in later chapters. We're going to need to file payroll tax returns periodically, and those all have due dates. Because there are so many requirements in the payroll function, they are paid fairly well. You're certainly not going to retire on a Caribbean island as working in the payroll area, but you can do quite well in the payroll area. It's a good area to get into. Some people really love payroll, and you can make an entire career out of it. If someone does that, they really do need to keep up with the changes, and there are changes practically every single year. Because this is such a dynamic field, the payroll the profession has its own organization called the American Payroll Association. Just like doctors have they belong to the American Medical Association, AMA. Well, this is the APA, American Payroll Association. You don't have to be a member of this, but being a member of it provides you with information and resources to help payroll professionals keep up with their jobs. They offer training, have publications that come out. There's even a certificate that's offered called the Fundamental Payroll Certification that someone can obtain to put on their resume to show that indicates that they are proficient in the payroll area. Like most professional organizations, they have their own code of ethics, and the code of ethics read much like the code of ethics of many other professions. Let you just kind of read through those. Okay, now we're going to cover just some of the major laws that affect the payroll profession that payroll professionals have to be familiar with to make sure that they're in compliance with what they're supposed to be doing. I'm just going to hit some of the highlights in these areas, but please read the chapter, and if you read the chapter a couple times, just absorb the material, you're going to do just fine in this course. So anyway, let's hit some of the highlights of what this is about. Probably the granddaddy law governing payroll is the Fair Labor Standards Act. It's also been referred to as the Federal Wage and Hour Law. This has been around for a long, long time. This law is really the subject of Chapter 2. We're really going to jump into this law in Chapter 2. But what does it really cover? Well, it covers minimum wage. I think we're all familiar that minimum wage is well over $10 an hour, but that's the state minimum wage that we have. The federal minimum wage is $7.25 an hour. Most people don't know that, but employees are supposed to be paid the higher of the federal or state minimum wage. But federal minimum wage, as set forth by the Fair Labor Standards Act, is $7.25 an hour and has been for a while. But we're going to cover this information in greater detail in Chapter 2. Talks about which employers are covered by this. Not all are. This is the law that requires maintaining records that will substantiate wage differentials between genders doing the same job. Most of you have had jobs, and you'll probably have noticed, maybe in the employee break room or somewhere, there's a huge piece of paper, poster actually, that lists out all these rights of employees that's displayed, that's required to be displayed, and it's required by this law. We're going to talk about the state's minimum wage and maximum hour laws. This is the overtime rules. Let's see here. We're going to talk about the rules that affect meal periods and meals and lodging, things like that. We're actually going to go over that in some depth. Another law that has been around for a long time is the FICA, which is commonly known as Social Security. The Social Security is actually made up of a tax on employees as well as employers. I know that probably doesn't make sense right now, but there is a tax that's imposed on both the employee, withheld from their paycheck, and the same tax imposed upon the employer. There is a second tax on the employee and the employer. So there are two taxes, and they both apply to both the employee and the employer. If you are self-employed, well, self-employed people are viewed as being both the employer and the employee. So they get to pay all four of them. Both taxes, both halves of both taxes. And so that's why it's kind of expensive to be self-employed. This law actually also governs the payments to retirees, basically, who gets the benefit of Social Security. We're not really going to talk about that much, and that's why I highlighted that in a different color. But this law does govern when people can start drawing Social Security and how much they get. But that's not what we're really concerned with in this course. We're concerned with more in, well, the money going into the system. Where does it come from? And so this is going to be the subject of Chapter 3. Chapter 3 will cover this in great detail. Next law, Chapter 4, will be the income tax withholding laws. This is the amount of income taxes that are withheld from our wages that we use to file our income tax returns. The more we have withheld, the less we'll owe at the end of the year, or perhaps the more of a refund we'll get. That withholding it's a fairly complex, not overly complex, but it's a little bit more complex than Social Security. There's two different ways to compute withholdings. We're going to see there's a percentage formula and a wage bracket chart. They should result in about the same amount. We'll cover that when we get there. State tax rates. We're not going to really talk too much about state tax, but I'll mention it when how the state of California computes theirs. When we get there, but this will be the subject matter of Chapter 4. Chapter 5 deals with unemployment taxes. Now, as employees, we don't pay into unemployment, but as an employer, which is going to be the perspective of our class, what does an employer need to do? Every employer of the state has to pay into an unemployment fund. And the tax is only leveled on employers. We're going to talk about a certain credit that they can get. Every state has this tax imposed upon the employers of that state. Because there's a lot of mobility of employees between states. There's a lot of uniformity between the rules in states. So if you understand one state, it won't take long to understand another. The rates may be different. Some of the waiting periods, the benefits available, that kind of thing may be a little different, but they all operate pretty much the same way. However, as you may guess, employers do need to be aware of the state unemployment laws in every state that they have an employee. One of the worst mistakes that an employer can make is not keeping adequate records of payroll. If they're paying employees right along, and if an employee has a complaint, perhaps they feel like they haven't been paid for all the time worked, or they weren't paid for overtime, or that there was an issue in some way, if an employer does not have records to support how they came up with the amount that they paid their employees, that's almost like a kiss of death. The employer is not only should keep adequate records, but are in fact required by law to keep adequate records. There's a chart here, and I don't expect you to memorize this chart, but based on the laws that we just saw, Chapter 2, Chapter 3, Chapter 4, and Chapter 5, they all require certain information to be kept regarding the employees that we have. Every one of them requires us to keep the names of the employees and their addresses. Only one requires us to make sure that we know what the gender was of each employee. That's the Fair Labor Standards Act, because that's the one that requires us to be able to support wage differentials between different genders doing the same job. Date of birth is needed for the Fair Labor Standards Act. But you can see down here, it's generally the Fair Labor Standards Act, the one that requires, I think, probably more than any other. But so as you can see, we want to keep a fairly comprehensive database of information on all of our employees so that we maintain the information that may or may not be required to support the payroll that we've paid. These are usually kept on a computer system, of course, as you can probably imagine in today's environment. There are other laws that employers have to be familiar with, and that one of which is the Fair Employment laws. This has to do with discrimination. That there's specific laws dealing with certain areas of discrimination we'll talk about in just a few minutes, but employers generally cannot discriminate based on age, race, color, religion, sex, or national origin, and that's been around for a long time. So we have to be familiar with what constitutes discrimination. Probably the very first law dealing with discrimination is the Civil Rights Act of 1964. That's commonly referred to as the Equal Employment Opportunity, and it provides for fair treatment of employees in the hiring and maintaining of employees. It actually forbids employers to discriminate, which is a good thing. Discrimination could be based on physical characteristics. If you find that if an employer is requiring unnecessary height or weight requirements, that could be excluding a particular race and could be construed as being discrimination unless there's a reason for it. This is also the Equal Employment Opportunity also deals with sexual harassment, which we've seen a lot of in the last few years. A lot of cases coming up dealing with sexual harassment, and the sexual harassment violates this act. So we want to be familiar with that as well. This act prohibits unions from excluding or segregating their members. So not only can employers not discriminate, but the unions that represent those employers cannot discriminate as well. Employment agencies cannot discriminate in referring applicants. So it's a pretty broad coverage of coverage for anybody involved in the hiring process. Okay. Doesn't cover everyone, though. That might surprise you, though. It does say that the Act covers all employers who engage in industry affecting commerce. That means doing business, and employ 15 or more workers for each day in each of 20 or more weeks in the current or preceding the prior year. So it sounds like smaller employees or smaller employers may not be held to as high a standard as employers who have 15 or more workers working in each day in one of 20 or more weeks. Employers specifically excluded, regardless of how many employees they have, are the United States government, or a corporation wholly owned by the United States government. Native Americans are excluded under this act. Private membership clubs, other than labor unions, and religious societies in the employment of members to do religious work, which basically says that if a Catholic church wants to hire someone to do religious work, do some religious teaching, they can require them to be Catholic. And that sounds like discrimination, doesn't it? But that really is one of the job requirements. So you can't, someone who owns a restaurant can't require all their waiters and waitresses to be Catholic. That's certainly discrimination. But a church, in hiring people who are providing that religious education and support, that can be, because there's a logical reason for it. So funny how the U.S. government excluded itself from this, but I think that we all agree that the U.S. government actually probably goes above and beyond to make sure that they are not discriminating in any way. It's probably good to be known that it's good to know that Title VII does not protect employees from arbitrary treatment or dismissal. That most of us, unless we sign an employment contract, we are called at-will employees, which means that if the job slows down or if I'm not doing my job well enough, I can be terminated, and I can't say, well, I was discriminated against, but because this law doesn't protect employees from being terminated because they're always late or they're just not good at their job or because there's just not work to do. It protects employees from being discriminated against. So when there is an issue of discrimination, the EEOC always attempts to work with employers to get them to remedy it on their own without going to court. But they will take employers to court if they find that there is an ongoing discrimination practices in there. If there's a state or local law that forbids discriminatory practices. Now, I'm not an attorney, but I imagine most states have laws to this effect as well. Then employees need to first address remedies through the state agencies before going to the federal agency. If it's found that that the discrimination has taken place, there can be compensatory and punitive damages where discrimination was in fact intentional. So they can be monetary damages for that. We did say that the federal government exempts itself specifically from this law. However, the employers that are not subject to Title VII here may come within the scope, may fall within the Civil Rights Act just by way of being involved with the federal government in some way. If you're doing work for the federal government, then just because you're a small employer and you're not under the specific rule of this law, you can be caught up in it because you are doing work for the federal government. But let's face it, probably the best thing to do is don't be discriminatory in your hiring and terminating practices, and you'll be okay. Age discrimination. Let's talk about specific areas of discrimination that have been addressed. One is age discrimination. The age discrimination prohibits employers and labor unions and employment agencies, those same people involved in getting people jobs. You cannot discriminate based on age. Now, the age involved in this is not 65 as you would think, it's 40. This is 40 years old, and so someone who was terminated and they were 45 and they feel they were terminated because they were older than the younger people, perhaps. I think this is more or less like the stewardess law. This came out of stewardesses that were being terminated when they got a little bit older. The airlines wanted young professional people to be the flight attendants, and so they were letting go of people over age 40. Well, this law protects people from being discriminated simply because they're over 40 years old. Now, there is an exception to this. It does say that executives who are 65 or over and have held high policy-making positions, that means that they have been part of the upper echelon of a company during a 2-year period. If they are over 65, a company can require them to retire as long as they have a retirement from the company of at least $44,000. This is probably a good law too. That way you don't have the 92-year-old guy who really can't get around very well, but he just won't retire. Well, this can require executives to retire because there's really not too many people above them that can fire them, right? It can require or it can have a company require retirement as long as they're paid at least $44,000, so they're not being left out in the cold. If someone claims that they've been discriminated against, employers are going to want to produce some sort of records that show that they were not discriminatory in their practices. That's why it's so important for employers to keep accurate records. Can't stress that enough. Starting with employment applications. And that's probably the very first record that's put into an employee's employment file, and then just basically records of advancements, wage increases, that type of thing. They should be maintained so that if someone does accuse the employer of discriminatory acts, they can show that they were not discriminatory. That perhaps any kind of a disciplinary action can be supported because they can show the reason for it and that it was not discriminatory in any way. Another very common discrimination is for people with disabilities. So the ADA came out in 1990. Says that employers with 15 or more employees cannot discriminate based on their disability, and that's a good thing. It basically says that that if a person is qualified to do the job with or without reasonable accommodation, then reasonable accommodations should be made for employees so that they can in fact do that. It applies right down the line for you, starting with the application process through advancement, training, termination. Those reasonable accommodations need to be provided. Reasonable, must be provided so that employment opportunities are available to everyone who can do the job. Other laws affecting this, I'm going to let you read through these. These are just various lesser-known laws, but they are. See, there's a lot of laws that have come out, and I'm certain these are not all of them, but these are the main ones. I'll let you read through those on your own. Okay. Oh, here's a mouthful. This is the Federal Personal Responsibility and Work Opportunity Reconciliation Act of 1996. So this has been around for almost 30 years. This act actually requires states to establish new hire reporting programs. What does that mean, new hire reporting programs? It means that every employer is required to report the name, address, and social security number of everybody they hire to a state agency to be put into a state directory within 20 days of hire. This is really I think that this is probably the child support law. This is where if someone is behind on their child support, and their wages are being garnished. They may just quit their job and go get another one, and wait for the state to catch up with them again. Well, this is a way to try to keep tabs with them, is to require employers to report who they're hiring to state agencies, so state agencies can keep tabs on pretty much where everybody is. And so if there is some child support or other reasons that they want to know where someone's working, that they'll know within basically 3 weeks of when they started working there. The employers with employees in more than one state only need to report to one state, because all the states are connected and they share information with each other. So as long as they report it to one state, they're okay. Some states even require this information now on independent contractors, which are not employees. This is like when a business hires a plumber to come in and fix the plumbing. Well, that's not an employee. That's an independent contractor, but that business is still going to pay them. And so this law is becoming a little bit broader, a little bit broader. It also reduces the fraud in unemployment, workers' comp, and welfare cases where someone is actually working but also drawing unemployment. So it's not I think it's a good law. It allows us to keep up with people. I don't think the fine in this area, I'm not even sure if this is correct. Failure to report this information can result in fines for up to $25 per new hire. I've never looked it up, but that doesn't seem like much of a fine. Certainly, it should be $2,500 per hire, but I don't know that that's the case. But it says $25, we'll go with that. But there is a fine. Employers, if they do not report their new hires, there will be a fine if they get caught. Here's the Immigration Relief or Immigration Reform and Control Act of 1986. This is to make sure that someone can legally work in the United States, and employers are verifying that employees can legally work here before they hire them. It requires employers to verify their eligibility to legally work in the United States. The employer has to just examine certain documents and have them complete what's called an I-9, employment eligibility verification, to make sure that they're legal to work here. Employers are not required to photocopy documents, but if you photocopy one, photocopy them all. So that way you can't be accused of being discriminatory in that. So if you want a driver's license and a social security card from everyone and you're going to photocopy them, then photocopies everybody's. Treat everybody the same. That's how you get around the discrimination rules. The I-9 is really the form that governs this. This is the one that employers have to fill out to show that they have in fact exercised due diligence in hiring practices, and has to be sent into the IRS. Section 1 of this form, it's got to be signed by the employee no later than the first day of employment. No lagging with this. If they come into work that very first day, that employee has to sign that. That's really an attestation that they are in fact able to work, that they can work. Section 2 is the one that gets signed by the employer, and that one has to be signed within 3 business days. Yeah, so they have 3 business days. The person signing Section 2 has to be the same person who examined the documents. If an employee does not want to sign this form, it can result in termination. If we find that we hire somebody, they come in, and we look at their information, and it comes to light that they are not legally authorized to work in this country, they must be terminated immediately. Yeah, the process of maintaining these I-9s for all of our employees should be centralized, and it should follow a due process. The same procedures should be done for every single employee. Interestingly enough, I did not know this, the I-9s should be kept in a separate file from other personnel records, because that information should be kept private. Interesting. It's got to be retained for 3 years. Well, in today's environment of cloud storage, I'd keep them forever. But they've got to, at least while the employee's working for me. But it needs to be retained for 3 years after the hiring date, or for 1 year after the date employment is terminated, whichever one is later. So it's got to be kept for a while. Just know that there's these records have to be kept not indefinitely. I would keep them indefinitely if I can do so without much cost. Of course, there can be fines for not following the rules. Look at these fines. Now these are more in line with what I would think the fines would be. That's why I think that other one, that $25 one, I don't know if that's correct or not. But so the fines here can be pretty heavy. The federal government's established a government-run internet-based system that allows employers to check the eligibility of new hires simply by putting in their Social Security number. It's a voluntary program, and employers don't have to go through this, to log in and put in the Social Security number of new hires. You don't have to do that. However, if an employer has a federal contract or a subcontract that contains a very E-Verify clause, then new hires should be run through there. And I think it's a good idea to do that. All new federal employees must have their eligibility confirmed through E-Verify because it's a federal program. So of course, federal employees should probably be able to pass that as well. Now, if there's a mismatch, we have to let the employee know because there could be a problem. There could be some sort of an error, and so they have 8 working days to correct it, to figure out what's wrong and correct it. Get a hold of the government and get that corrected. And if they cannot, or if they do not, then they need to be terminated. The Family and Medical Leave Act of 1993. This requires employees that have 50 or more employees within a 75-mile radius for at least 20 weeks. The employer has to grant them unpaid family or medical emergency leave. That means that we have to give them time off. We don't have to pay them, but we have to give them time off, and then they get to be able to come back to their job. They get up as many as 12 weeks of unpaid leave. Doesn't have to be taken all at once. It can be done at different times and at different points in time. However, it must be taken within 12 months of whatever the qualifying event, whatever happened that's requiring this leave. It should be taken within 12 months of that. Employers must continue health care coverage, though. So it's not going to be a freebie to the employer. They still have to pay the health care coverage that they were providing to them. Don't have to pay them a salary. But you got to keep their health care going. And they must guarantee that the employee can come back to their job or a comparable job. Employers can substitute some paid leave like sick time or vacation time for part of that 12-week family leave, as long as the employee is notified within 2 business days that the employer is going to do that. Employers can, in fact, pay employees on this medical leave at least 50% of their normal wages. If they do that, they pay them, give them a half time, even though they're not going to be there. They're a good employee. We want to pay them at least half their wages. There can be an income tax credit available. I'm not going to require you to know what these percentages are, but the federal government will help those employers that help those employees on this family and medical leave. Yeah, it does not apply to employees with wages over $78,000. These are the bigger hitters, the ones that make a lot of money. Well, we won't help employers with those, but for the ones who don't make as much money, we will. Yeah. Notice that this has been expanded to a family member who's on active duty, or when an employee cares for a member with a serious injury incurred in the line of active duty military service. The 12 weeks is bumped up to 26 weeks. Can't do enough for our military personnel, especially if they are hurt in the line of their service. Could be entitled to even additional time if they qualify for it. Employers can exempt, though, from this 12-week, giving somebody 12 weeks off without pay. They can exempt the highest 10% of their workforce, which basically means the executives. It's pretty hard for a company to go on without their controller or maybe the vice president of the company for 3 months. They may do so anyway, but they're just not required to do so. Also, if an employee hasn't worked at least 1 year and has at least 1,250 hours, you got to pay your dues. You got to earn the right to do this. You can do that. You got to have a little history with the company in order before you can take 12 weeks off. Yeah. Employers can contact employees' doctors for verification, clarification, to make sure that this is really something that's serious. Should not be done by the employee's direct supervisors. That's a little too close. Yeah, should be done by someone in maybe in the personnel department who doesn't work directly with this employee. Definition of spouse, of course, has been expanded to include same-sex and common law marriages. Some states even have paid family medical leave. So, want to be familiar with the Family and Medical Leave Acts in each state that we have employees. Next up, we've got the Uniformed Services Employment and Reemployment Rights Act. It gives military personnel the right to take leaves of absences from their civilian jobs to go serve, and then it gives them the right to come back to their job with accrued seniority, unless they were dishonorably discharged. If they didn't do what they were supposed to do, then they don't get to come back. But they generally, if they take a leave from their civilian job to go serve in the military, they get to come back to their job. Their job must be reinstated within 2 weeks, and health benefits must be started without any waiting period. So, again, can't do enough for our military personnel. This is ERISA, the Employee Retirement Income Security Act of 1974. This goes back a little ways earlier than some of these other laws. This protects employees' retirement packages. Now, let me start by just saying that this law does not require employers to provide retirement for employees. Yeah, just because this law exists doesn't mean that an employer has to put money aside for an employee's retirement. But if they do, this law protects those funds. When an employer does establish a retirement plan or program for their employees, this law protects those funds to make sure that those funds are still there, and that the employer can in fact fulfill those promises to employees. If there's an employer pension plan, every employee is eligible after reaching age 21. You can't pick and choose who gets the retirement benefits. After 1 year of service and age 21, they get to start participating in the retirement plan. A couple different plans we'll talk about a little bit later. Has to do with defined benefit plan or defined contribution plan. Just real quick, defined benefit plan is when an employer promises that they will pay a certain amount in retirement. So that may be a formula based on wages, but they're just saying, okay, well, if you stay with us for 30 years, we'll give you $5,000 a month. They're defining what the benefit to be paid in the future is going to be. Defined contribution plan, they're not making any promises about what an employee will make in retirement. They're just saying, we're going to set aside a certain amount right now this year. We'll put it into an account for you. We don't know what it's going to be when you retire or what it's going to provide you, but our promise is just that we're going to put away X amount of dollars right now. So defined contribution is much less risky because an employer says, I'll put away $1,000 a year. Once they put away $1,000, they've fulfilled their responsibilities. This law protects that $1,000, sets it aside, puts it in a separate account, that type of thing. Just make sure that employees, it helps to make sure that employees get what they're supposed to get. Vesting deals with if an employer says, hey, we'll provide you retirement after working for us for 30 years. Do you have to wait 30 years? Can they let you go in the 29th year and not have to pay you anything? And the answer is no. Actually, you get to you vest in it, and I don't know where the term vesting came from, but it just means that you have earned that retirement. And if you leave, say after 5 years, you can take what you've earned with you. They have to pay you out. They have to cash you out on your retirement. It's yours, vested. You vested in it. And vesting is it's the money that suppose they're under a defined contribution plan, and they say that we're going to put away $1,000 a year for you every single year. So they put away $1,000 in your first year, $1,000 in your second year, $1,000 in your third year. If you terminate your employment and leave, do you get to take that money with you? Is that your money? Well, it depends on how it vests, and it has to vest one of two ways. Either it's 100% invested at the end of the 5th year, which means that you have to stay 5 years before you get to take anything, or it can vest 20% a year starting in the third year, 20%, and it's fully vested in 7 years. So it invests slowly over 5 years. Extends it out a couple years, so employees aren't fully vested in 7 years, but they do start getting to keep some of it in the third year. So it's up to the employer how they want it to vest. Employers that have these pension plans have to file annual reports with the Internal Revenue Service to show what monies they've put aside and just to disclose the requirements of the retirement plan that they have. Some different rules here. Disclosure requirements. I'll let you read through those. Interesting that retirement plans need to be audited by certified public accountants to make sure that they do in fact exist. It's probably one of the best ways to make sure that an employee will get their retirement benefits is to make sure that the funds are actually out there somewhere and that they're certified to exist by an independent certified public accountant. Here's the Obamacare Act that you've probably heard of, and this is the Affordable Care Act. This is made up of 2 pieces of legislation here that's indicated here. This is just we're basically trying to get health care coverage to all individuals. Prior to 2017, the federal law required most employers to provide health care insurance to their employees, and it was repealed in 2017, which just was not a good program, but it was applicable to employers with more than 50 full-time employees. That's a pretty good size company, and if they have more than 50 full-time employees, then they have to provide health insurance coverage for all full-time employees and their dependents. It's just you got to provide that wage package. They're just trying to get employers to provide health care for their employees. Smaller companies that have fewer than 50 that are not required to provide health care, if they do anyway, then the federal government will help them with that. There's a credit, a tax credit that they can take on their return for a certain percentage of those health care benefits. The federal government will help smaller employees that aren't required to provide health care to, in fact, provide it. So they are trying, and these are fairly new laws in this area. Should be familiar with them. There are other state laws that affect the need to keep track of certain records. Got to be familiar with the state laws. And we're not going to cover really state laws because I'm sure this textbook is used across the United States, and so we can't cover every law in every state. So, but there are laws in California that need to be adhered to as well in determining that. There's worker compensation laws. Every state has worker compensation laws, and these are basically just insurance policies. So if employees get hurt on the job, and this is on the job, not at home, but they're at work and they get hurt, then there's an insurance contract that will pay them salary, pay them medical benefits and that type of thing, and also pay their spouses or dependents in case of illness or death or disability. Employers are required to pay into a state compensation insurance fund or buy their own insurance policy or establish self-insurance. Most pay into a state established fund. This is what we're going to be covering in Chapter 5. And it's not a voluntary thing that employers do. They've got to do this. This is just another thing that as wearing the employer hat, you've got to set up the workers' compensation fund and pay into that. In most states, just the employer pays into it. It does say that there's a few states where employees actually pay into it as well. It's based on gross payroll. More on this in Chapter 6, actually. We're talk more about the computations of this. But it's based on payroll, so the more payroll an employer has, that obviously means that's more employees they have, and the more they're going to pay in to the fund for the coverage of those employees. State disability. California we have a disability. That's one of the things that are withheld from employees' wages is SDI, state disability insurance. This is really insurance that will pay employees when they get hurt, not not on the job. So if you're at home and you get hurt and you can't go to work, well, then you can claim SDI. It's not nearly as much as workers' comp, but it will pay the employee while they're on disability and they can't go to work after being hurt, not related to the job. Employees pay into that. Okay, well, I think that this is a good point to stop this video. We'll start the next one right here, where we're going to talk about the human resources, which accompany the entire area of dealing with employees, and the interrelation of that department with payroll, which really just concerns the paying of employees, of paying those employees. So we'll talk about the relationships there, and that'll be in the next video.